All right, let's talk about a single mindset shift that can honestly change every financial choice you make. It's this simple idea. Almost everything you do with money, from your salary to your investments, has a kind of hidden tax component. And if you're ignoring it, well, you're just not seeing the whole picture.
So let me ask you this, and be honest with yourself. When you're looking at a number, say a salary offer or an investment return, which number are you really focused on? Is it that big, flashy number on the paper, or is it the one you actually get to take home and, spend? And let me tell you, the difference can be pretty shocking. That big, impressive number you see on the surface, that's the before tax number. It's the headline. But the reality, the number that actually builds your wealth, is what's left over after tax. Seriously, focusing only on that top number is like trying to navigate around an iceberg when all you can see is the tiny tip. You're missing the most dangerous part underneath. Okay, so that brings us right to the core of what we're talking about today, the after-tax mindset. It's actually a really simple rule, but it's powerful. The only number, the only result that truly matters in any financial transaction is what you're left with after taxes are paid. Period. All right, to make this crystal clear, let's use an example pretty much everyone can relate to, a pay raise. So imagine your boss tells you you're getting an $8 an hour increase. That's fantastic news, right? You start doing the math in your head, but once you put on those after-tax glasses, you realize the reality is a lot more complicated for everyone.
This is where it gets really interesting because that single $8 figure creates two completely different realities. Okay, so look at the employer. For them, at let's say a 27% tax rate, that $8 raise isn't actually an $8 cost. No way, because it's a deductible expense, their real out-of-pocket cost is just $5.80. Now flip over to the employee. For them, assuming a 50% tax rate just for this example, that $8 raise isn't an $8 gain, it's only $4 in their pocket. So you have the same $8, but it means two wildly different things to the people involved.
And this really brings us to the most important takeaway, which is put perfectly here. The real decision-making, the smart decision-making, it all has to happen after tax, not before. That right there, that's the fundamental shift in thinking we're talking about. Okay, so if we all agree that the after-tax number is the one that really counts, what's next? Well, this is where it gets empowering. It leads to this huge shift in perspective. You stop seeing tax as just this fixed penalty you have no control over, and you start seeing it as a manageable cost. I mean, think about it. If you run a business, you're constantly managing your costs, right? You negotiate your rent, you try to keep the utility bills down, you set a budget for salaries, so why should tax be any different? It shouldn't be. It's just another expense on your list, and it's one of the biggest. The difference is, it can actually be managed strategically. Of course, you can't manage what you don't understand. That's the first rule of anything. So the key is to figure out the variables, the levers you can actually pull to influence that final tax number. So let's break that down right now. In a tax system like the one in Canada, for example, there are basically four main levers you can pull to shape your financial outcomes. And trust me, understanding these is absolutely the key to taking back control. Okay, lever number one is the type of income. It's super important to get this. Not all money is created equal in the eyes of the taxman. The money you earn from a business is taxed differently than, say, rent or dividends from an investment. And that's different again from your regular salary or capital gain. So the very nature of your money, its character, is the first big variable. Next up, lever number two is the type of taxpayer. So who or what is actually earning the income? You, as an individual person, play by a completely different set of tax rules and rates than a corporation does. And then you have trusts, which are their own unique thing. So choosing the right entity to earn the income is a massive strategic decision. Then we have lever number three, your business structure. This is all about how you're organized. Are you a sole proprietor, where all the business income just flows right onto your personal tax return? Or are you set up as a corporation, which is a totally separate legal entity with its own tax rules? That one choice right there has huge, huge tax implications down the line. And the fourth and final lever is jurisdiction, or put simply, where you earn your income. It absolutely matters. Different provinces have different tax rates. Earning money in another country, that adds a whole new layer of complexity and rules. The takeaway here is that geography is a key piece of the puzzle. So, okay, you've got these four powerful levers you can use. The whole goal here is to use them for something called tax planning.
And this is where we need to be incredibly clear, because we have to draw a bright, bold line between what is smart and perfectly legal and what is a serious crime.
When we talk about legal tax planning, there are really three main goals. First, you want to reduce the amount of tax you have to pay, using all the rules available to you. Second, you might want to defer a tax payment, basically kicking the can down the road to a future year. And third, you want to postpone paying that tax for as long as you legally can. See? It's all about strategic timing and reduction, all within the lines. And let's just hammer this point home one more time, because it's that important. Tax planning is completely legal. It's just you strategically arranging your affairs to pay the minimum amount of tax you owe, using the law exactly as it's written. Tax evasion, on the other hand, is illegal. That's when you're actively hiding income or making up fake expenses to cheat the system. One is smart, the other will land you in a world of trouble.
So at the end of the day, why go through all this trouble? Well, when you actually manage to bake this after-tax mindset into every decision, the payoff is huge. You literally improve your cash flow. You start making smarter business and investment choices. And the big one? You maximize what you're actually worth over the long haul. Look, if you walk away with just one thing from this explainer, let it be this. Taxation isn't just some annoying thing that happens once a year when you file your return. It is an active, living, critical part of every single financial decision you make. I mean, everything from buying a coffee to buying a company. So there you have it. You now know the difference between the before-tax illusion and the after-tax reality. You know that tax isn't just a penalty, it's a cost you can actually manage. And you know the 4 fundamental levers you have at your disposal. So really, the only question left is, what are you going to do with it? How are you going to use this knowledge to shape your financial future?